All right, in this video, I'm going to try to go through some homework questions for you. I went through all 15, and there's obviously a lot of questions surrounding direct write-off method. There's some questions surrounding the allowance method, percentage of sales, percentage of receivables, percentage of days outstanding. I'm not going to go through every single question. I think it's important for you guys to start getting comfortable doing most of it on your own, but I do want to at least do a couple of questions um, in each of those separate categories. So, with that said, I'm going to do first one for you. Okay, so sold 30,000 of merchandise, which cost 23,000 on MasterCard credit cards. MasterCard charges a 5% fee. So what we're saying here is we're selling merchandise to a customer, and the customer is using their MasterCard. And MasterCard charges us a 5% fee. So the way that I would handle that is I would do the sale of the inventory first. Okay, so I'm definitely going to recognize cash, not cost of goods sold. Cash. Come on. All right, cash. There we go. And the amount I'm going to hold off on for just a second, but I definitely have revenue or sales. Maybe we can do sales of 30,000. Okay? Now, the customer is using their credit card and we're getting charged a 5% fee, and therefore we have what we call a credit card expense. Credit card expense. And the amount of the expense is going to be 5% of 30,000. And you guessed it, I can't do that in my head. So I'm coming up with a $1,500 expense, right? Expenses are equity. They have the effect of lowering equity since equity is on the right side of the accounting equation. If I want to lower equity, I would do it with a debit to credit card expense. And then the net difference is how much cash we end up receiving. And in this example, is it not going to be 28,500? Check my answer. It's probably going to be incomplete because I haven't done, right, the next portion of the credit question, which is where I would record the cost of the goods sold and then also do the second journal entry. Okay? I'm going to do the second journal entry on my chalkboard, better known as oh shit, time to really pay attention because I can't read a word he's fucking writing. Okay, so the second part of the question was of the first portion was the inventory cost us 23,000, and therefore I would debit cost of goods sold 23,000, and then credit merch inventory 23,000. And I believe I would leave the rest to you on that one. Bear with me. Okay. The next question I wanted to do was question 3 for you guys. Okay. Question 3 has to do with recovering a bad debt, right? So we wrote somebody off and then it turns out that they're actually paying us back. Okay, so Solstice Company determines on August 1st that it cannot collect 65,000 of its accounts receivable from its customer, P. Moore. It uses the direct write-off method to record the loss on October 1st. Then on October 30th, Moore unexpectedly pays his account in full, record Solstice entry for the recovery of the bad debt. Here's the deal. I think I want to do the first journal entry, the write-off. It's not part of the question, but I just want to show us what the original write-off looks like, because if I understand what the original write-off looks like, I think it's just easier to do the recovery. Okay. So if I'm using the direct write-off method and I just wrote off a customer 65,000, it's going to be bad debt expense 65,000. And then it would be accounts receivable, I think it was more, 65,000. Okay? And now if more suddenly pays us, then the first journal entry I have to do to recover the account, and this is where the question starts, is I have to unwind the bad debt expense. So I have to put accounts receivable back on the balance sheet. Sorry. And then I have to lower that bad debt expense because it's not bad debt expense anymore. Customer actually paid. Then I can record the receipt of cash. And then again, take the accounts receivable off the balance sheet. Crazy. But anyway, that is how we would record the recovery, right? This portion of the question, or this portion of my explanation, is what you would do in the question. But for me personally, since I have a small brain, it's helpful for me to understand what the original write-off looked like. Okay, next question I want to go through with you is question 5. Where's question 5? Question 5 is asking us, Gomez Corporation uses the allowance method to account for uncollectible accounts. On January 31st, it wrote off a $2,500 account for a customer C Green. And then on March 9th, it receives a $2,000 payment from Green. Prepare the journal entry for January 31st and then do the March 9th. Okay, so the January 31st, where we're going to write off 2,500. Hopefully I'm still sharing my screen. I am going to write off it's 2,500, 2,500. And when I'm using the allowance method, remember I created allowance for doubtful accounts and I had some credit amount in there. And therefore, when I write off, I'm going to debit the allowance for doubtful accounts. So allowance for doubtful accounts, 2,500. And then I would also credit accounts receivable for this particular customer, Green, 2,500. And then the question said, hey, you know what? We actually ended up recovering. We recovered some portion. Okay, next question I want to go over with you guys is question 10. Assuming I could get to question 10. Okay, in this question, we are going to cover the percentage of accounts receivable using the allowance method, obviously. Okay, so Mazzy Supply Company uses the percent of accounts receivable method on December 31st. It has outstanding accounts receivable of 89,000, and it estimates that it will be not collecting 4%. Prepare the year-end adjusting entry to record bad debt expense under the assumption that the allowance for doubtful accounts has the following. First scenario, the allowance for doubtful accounts has $1,513 credit balance, and then scenario 2, it would have a $445 debit balance. Okay, I'm going to go back to my screen, and we said that accounts receivable has a, what was the amount? I think it was 89,000. So we've got 89,000 here. And then in scenario 1, my allowance for doubtful account, and then I'll just say this is scenario 1. The allowance for doubtful accounts, the balance has a credit balance of 1,513. So it has a credit balance of 1,513. So when I'm using the percentage of accounts receivable or the aged receivable approach, the first thing I'm going to do is I'm going to try to calculate, I'm going to calculate the amount of total uncollectible. And in our example, we said it was 4% of accounts receivable. So 89,000 times 4% is, I get 3,560. So what we're saying is we want the allowance for doubtful accounts to be 3,560. However, if it's already 1,513, then the adjusting entry needs to be the difference between those two. It needs to be, what do I need to add to allowance for doubtful accounts to move from 1513 to 3560? And I get 2,047. That's the worst looking 2 I think I probably ever wrote. 2,047. So the adjusting entry under scenario 1 is going to be bad debt expense, 2,047 debit. And then I would credit allowance for doubtful accounts, 2,047. Right? So this is the adjusting entry, right? It's what we have to add or adjust that allowance for doubtful accounts. It's not the entire 4% of accounts receivable. Okay? All right, now let's look at scenario 2 for a second. Scenario 2 is saying, hey, the allowance for doubtful accounts, it's still the same accounts receivable, right? None of the accounts receivable information changes. We're still saying we're not going to collect $3,560. However, the second scenario, B, is it saying that the allowance for doubtful accounts has a debit balance of 445, right? And what we need to do is we need to get it to 3,560. So the reason why it's going to have a debit balance is because in the previous period, we experienced more write-offs than we thought we would or that we normally do, right? And it could be a whole host of reasons. It could be the economy really slowed and it was an unexpected slowdown, and because of that, more of our customers were unable to pay their bills, so we wrote off more accounts than we had available to us, right? Remember, every time I write something off, it's always a debit to the allowance for doubtful accounts. So last period, we ended with 445 debit dollar balance. And now we need to get to 3,560. So what do I need to add to the credit side to go from 445 debit to 3,560 credit? Well, it's going to be 4,005. So the second scenario would be bad debt expense, 4,005, and allowance for doubtful accounts, 4,005. Okay, last question I'm going to go through with you, right? This one has to do with notes receivable. On August 2nd, June Company receives a 7,790-day 15% note from customer Brian Albany as payment on his 7,700 account receivable. Okay? Compute the maturity date for this note if it's 90 days, and then prepare June journal entry for, sorry, prepare John's journal entry for August 2nd. Requirement 2. I'm going to do all sorts of stuff with this question, okay? I'm going to do more than what the question asks. But to compute the maturity date, right, I am issuing it on August 2nd, and it's 90 days, okay? So what I think I would do is I would first figure out how many days do I have left in August? How many days are in August? Man, January, February, March, April, May, June, July, August, 31 days. I do the knuckle approach. So there are 31 days in August. However, I issued the note on the 2nd, and therefore the number of days I have left are 29 in August. Then I would take all of September. That's going to get me to 59. I got to keep going. October. Am I going to take October? How many days? 31. That would get me to 90. Is that right? 59 plus 31? Man, am I good. So I guess October 31st is the maturity date. Fair enough. Okay. That was requirement 1. What's the second journal entry? Sorry, the second requirement is the journal entry on August 2nd. And again, remember, we are converting accounts receivable to notes receivable. So the journal entry on August 2nd would be note receivable. I apologize. The amount is 7,700. And we would get rid of accounts receivable, 7,700. That would be August 2nd. How about we do October 31st? October 31st would be, let's assume the customer pays on October 31st. So we are definitely going to receive cash. How much we're going to receive, not sure just yet. I'm also going to earn interest revenue, right? The customer is going to pay, I can't remember what the rate was just yet, but we're definitely going to earn interest revenue. And then we're going to get rid of the notes receivable. That part I already know. Notes receivable, I am going to credit that 7,700. And this should be 7,700. Okay, so interest. How many, or what was the interest rate being charged? 15% in this example. Okay, so we would do 7,700 times an annual rate of 15%, and then we need to adjust it by the number of days in this period. It would be 90 divided by 360. Remember, 360 being the banker's days. And if I do that math, the math is 7,700 times 0.15 times 90 divided by 360. I'm getting $288.75. I'm just going to double check that. 7,700 times 0.15 times 90 divided by 360. $289. and therefore the cash that we are going to receive will be $7,989.